welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
If wars had comment sections, they'd end in 5 minutes from sheer embarrassment. Diplomacy is the art of saying, interesting point, when you mean, absolutely not. Self-help books always say, unlock your potential. Mine must be password protected. Scrolling is the modern equivalent of entering a room and forgetting why you came. We're forming a committee is bureaucracy's way of tucking a problem into bed.
Here's a chart that settles the debate. Since the launch of ChatGPT, Alphabet hasn't just outperformed Microsoft, it has absolutely moonwalked past it. Google, once accused of sleeping through the AI revolution, is now up more than 200%, while Microsoft is barely at half that pace. So what happened? Google quietly did the unsexy but legal thing. It plugged AI into every product with billions of users. Search, YouTube, Android, ads. Creating the fastest monetization loop in tech. Meanwhile, Microsoft's AI wins are real, but the revenue flywheel spins lower. In short, the early hype crown went to Microsoft, but the scoreboard today, Google by a landslide. Here's a snapshot of today's startup hierarchy. And spoiler, unicorns aren't just valuable, they're borderline mythical. OpenAI sits at the top with a jaw-dropping $500 billion valuation, basically the GDP of a mid-sized nation. Right behind it, SpaceX comes in at $400 billion, proving rockets and AI are the only two hobbies investors currently approve of. Anthropic at $350 billion and ByteDance at $300 billion round out the top tier. A reminder that the biggest unicorns aren't apps anymore, they are infra for the future. The rest of the pack, Stripe, Shein, Canva, Ripple, Revolut, look almost humble in comparison, even though they are worth tens of billions of dollars. Here's a chart that flips the usual narrative. Everyone keeps talking about an AI bubble, but look closely. And it's actually Indian tech that's floating miles above Earth. Zomato at 156x EV by EBITDA, Physicswala at 131x, Nykaa at 129x, and even Paytm at 91x. These aren't multiples, these are launch trajectories. EV by EBITDA is basically enterprise value by EBITDA. Now shift to the so-called AI mania. Palantir is the only true outlier at 448x. But beyond that, Tesla is at 100x, Nvidia at 42x, Apple at 28x, Google 7x, Samsung at 6x. These are practically value stocks compared to Indian tech's Himalayan premiums. Here's the ranking that everyone secretly checks. Which B schools actually deliver the fattest paychecks? And based on the data submitted for the NIRF 2025 management rankings, the crown this year goes to IIM Mumbai with a median salary of 33 lakhs. And right behind is IIM Bangalore at 32.5 lakhs, IIM Ahmedabad at 31 lakhs, the classic big three, but in a slightly surprising order. Calcutta and Lucknow follow close at 30 lakhs, while XLRI comes in at 28 lakhs. The rest trail gradually, with IIT Delhi closing the chart at 22 lakhs. And if you're wondering why your favorite school is missing, well, odds are they simply did not submit their data. In management as in life, showing up is half the battle. Retail sales jumped 11% year on year in the August-October 2025 period, and the reasons are classic: a well-timed GST rate cut and a full-blown festive shopping surge. The monthly trend tells the story clearly. Growth was steady through the year, but it's a festival quarter that sent the numbers soaring. Regionally, the West led with 13%, while the East and North clocked 10%. South trailed slightly at 9%. Category-wise, it's a consumer comeback. QSR leads with 15%, furniture at 13%, and footwear, groceries and jewelry all at 12%. Apparel and beauty held steady at 9%, while consumer durables lagged at just 6%. Put simply, the Indian shopper is back and spending with conviction. Japan's debt matrix always shocks on paper. A gross debt of 240% of GDP, the highest among major economies. But analysts often point to Japan's much lower net debt, which is around 130%. The catch? For net debt to matter, markets need to believe that the government is willing and politically able to sell those assets to reduce gross debt. Otherwise, net debt becomes an accounting comfort blanket that investors ignore. And if the bond charts tell us anything, it's that the market still prices Japan based on gross debt realities and not theoretical asset sales. Until Tokyo shows it's ready to actually use its balance sheet, the net debt story remains just that, a story. Here's the Indian market in 2025 summed up in one chart. The Nifty 50 is up 10%, happily sprinting ahead, while small caps and micro caps are lying somewhere behind the stadium looking for electrolytes. The small cap 250 is down 6%, micro caps are down nearly 8%, a full 20 percentage point gap between the giants and the minnows. Why the great divide? Simple. When volatility rises and global cues wobble, investors cling to safety like it's the last seat on the flight upgrade. Blue chips get all the love, liquidity, and research notes. Meanwhile, smaller companies get the financial version of "we will call you." This year, the market isn't rewarding bravado; it's rewarding balance sheets. If you want to know where India's global muscle really shows, look no further than this chart. Jamnagar is in a league of its own, exporting a jaw-dropping 3.96 lakh crores, practically lapping up the competition. Next up was Kanchipuram at 1.14 lakh crores, and then the heavyweights Bombay, Pune, Surat, and Ahmedabad, all clocking impressive numbers across manufacturing, gems, autos, and electronics. So, what's happening here? India's regional clusters have quietly turned into export machines. These districts aren't just pushing products out of ports, they are exporting resilience, innovation, and serious industrial discipline. And together, they are shaping India's global footprint far faster than most people realize.